Right, good morning, everyone. Ben Seeger-Scott here, Chief Investment Officer here at Mazars. It's 10 o'clock, so it is time for the bi-monthly economic and investment update. Joining me today is George Ligarius, our Chief Economist, based out in Athens. We'll go through the usual running order. Zach is driving the slide, so if we can go on to the agenda, we'll talk through. What I thought we'd do this time is I will talk through market performance, then hand over to George, who will give the broad economic update, but also talk about some of the interesting developments we're seeing, particularly around some of the trade wars that's becoming evident between the US and China, but perhaps we'll see Europe get involved. And I think there are some historical parallels it'll be useful to look at. And then it'll come back to me. I want to talk a little bit about portfolio activity and asset allocation. Then at the end, we'll wrap up with a Q&A. I know some people have already submitted some questions, so we will look at those in the Q&A. There's also a Q&A button at the bottom. So if you do have a question through the course of the webinar, please put it in there and we'll pick it up at the end. I'll have my video on while I'm talking and then hand over to George for his sections for picking up sections 4 and 5. So without further ado, let's dive straight into the next slide, market performance. What I'll do over the next few slides is talk a little bit about what's happened in markets, mostly focusing on equity and bond markets for this one. But this side here, just looking over the last 12 months, this shows the performance of major markets. This is in sterling terms on a total return basis and just shows gross market performance. I've also put in a little dotted line there that talks about the previous webinar. And I think there's a couple of things to really pick up here. I'll talk in a moment through the different anatomies of this, but looking over the 12 months, what you can really see is the rally point around about last November time. This is when we really saw a transition in markets that have been bumbling along until that point. November's when we saw the Fed and other central banks start talking about this pivot from hiking rates to pausing, and now everyone's been talking about cutting, and that's triggered this extended rally. I think what I would highlight, since the webinar we had 2 months ago, just after I joined, you can see actually there's been this little bit of a smile. We're on weekly data, so it looks more like a V, but you can see on that slide what we had since the last meeting is equity markets. So if you look at the blue lines, the dark blue at the top, that's developed market equities. You have to cast your eye lower to see the light blue line, which is emerging market equity. But you can see equity markets dipped, followed by a rebound. So actually on the 2 months we're looking at, not a lot has happened. That's been because equity markets fell and then subsequently rallied. You can see corporate bonds and government bonds in sort of brown and beige at the bottom haven't been particularly exciting over this period. But we see this sort of worry in markets. A lot of that was driven by interest rate and inflation concerns. I've got some bits on bonds a bit later, and then George will talk more about inflation. But you can see this is a classic investors getting just broadly worried. You see that because equity markets are dipping, and that gold line, which obviously is the gold price, spiking up. It's sort of what we saw back end of last year as well. And that is a classic when investors are worried, particularly around inflation. You see equities dipping and gold picking up. Bonds less affected because it is inflation. You don't have that growth shock characteristic. But with gold popping up and equities dipping, you can see there's a little bit of a wobble. But it only lasted sort of a few weeks before rebounding back up. And the other thing I'd sort of note here, even though developed market equities, it's sort of equity markets falling, then rebounding effectively where they were before. One thing we have seen that's been a little bit different here, and in a second we'll lead on to my next point, is you can see emerging markets which have been left behind a little bit. And if you've listened to our previous webinars, we've talked about emerging markets and to an extent the UK being left behind. You can see this rally over the last 6 weeks following that dip has started to benefit those emerging market equity. So now let's talk a little bit more about the anatomy of this rally. What we're seeing here is the 12 months which I think is useful to put in context. But on the next slide, we've got this anatomy of a rally. So this is taken from that November point that I just talked about, when markets really started to pick up. And I want to dissect this. I apologize, this is quite a noisy chart, but there's a lot of detail that I want to sort of elucidate out here. And it's these 4 different phases that identify. It is easy when you just look at global equities overall, and that's the dotted line you see here, just say, oh, it's just been one big rally. It's been fairly homogenous. When in fact, and some of the bits we have been talking about for the last few months, but is even more in evidence now, this broad rally actually has several distinct phases, and different parts of the market have benefited at different times. We've talked about it verbally. I think it's useful just to draw out, particularly the first 2 that people haven't really focused on. This starting point from the beginning of that rally in November, December time, it was actually pretty broad-based. It wasn't necessarily just AI, and this was a relief rally. Anytime that you have central banks say, right, particularly when there's economic strength, say that we're at the end of a hiking cycle and the next move might be for a cut, that led that broad market rally. You also have a bit of a European boost around the start of the year. Some of the worries, particularly around the war in Ukraine, that was causing a bit of a discount in European equities, that started to dissipate. And that was a pretty broad-based rally from November into January. And you can see here, most of those lines sort of going up. These are largely done on regions. The sort of teal line, which is the Magnificent Seven, we talked in the last webinar that the Mag 7 is actually just 1 or 2 companies. A lot of that is Nvidia, which makes the chips that go into AI. That one stock has done phenomenally well. The rest of the Magnificent Seven have been mixed. Microsoft and Facebook owner Meta have done quite well. Apple is actually flat this year. Tesla is down. So even the shorthand of the Magnificent Seven isn't particularly helpful. But for our purposes now, it's probably useful enough. And what you can see, we have that initial rally. But then the second phase from sort of January through to April, you can see that dark teal line. The Magnificent Seven at the start of the year were actually flat to slightly down. You can see that huge boost at the start of the year as the Magnificent Seven really rallied hard, got up to the sort of mid-20s. And that's, as we have said before, that's this relief rally giving way to a really AI-led rally. You can see it was those US mega cap stocks driving performance. That has actually meant over that particular period, the growth in multi-asset investments has been exceptionally narrow. As we've said before, it has been just those mega cap tech names that really boosted performance, particularly over that time, and has created a challenging environment in equity markets generally. But since then, we've seen market drivers start to broaden out. So we had the relief rally, the AI rally, then we had this inflation wobble. And post that wobble, the 2 markets that benefited, I mentioned emerging markets. You can see that at the bottom. But if you look at the gold line, gold is now UK equities, and UK equities have really benefited in the last few weeks. The UK has been a particularly unloved market. It's been trading on a discount. It has, as you can see through most of this year, and as we talked about before, it's been a laggard. Most of our conversations have talked about global equities rebounding, but UK and emerging markets being left behind. This last phase, we've seen those 2 markets in particular catch up. And what it means from that rally, the Magnificent Seven are still ahead. And as I said, that's largely just down to one stock. But if you look more broadly at regions, you can see there's a heavy clustering effect. Europe, US, UK, all clustering around that 15-16% return year to date. Japan and emerging markets doing okay. Emerging markets, particularly on that recent rally. Japan doing well earlier in the year. They're not too far behind. So actually this rally that started out very narrow has been broadening out, and it's easy to miss that if you just look at the single global market figure. So there's been lots of interesting detail within that. On the next slide, I'll touch on, and then the subsequent slides dissecting. A lot of the news recently has been about markets at all-time highs, fresh all-time highs. That's obviously happened in the US late last year, early this year. Since then, that's the dark blue line hitting all-time highs. European equities, the Euro stocks has done very well at the start of this year. That boost from some less concern around the war in Ukraine has helped European equities just about get to new all-time highs earlier this year. Then in the last few weeks, you can see the UK has joined, and that's the sort of greeny, grey, beigey line. You can see that recent boost has meant that the UK is now hitting fresh all-time highs as well. That's positive in many senses. In fact, the UK that we've talked about being unloved, if you just look over the last 3 years, the UK has done better than US equities. Because obviously when we had those initial shocks, inflation concerns, that's an area the UK market benefited from. So it didn't have that dip in 2022 and held together quite nicely. Obviously, that's good news for investors holding these assets, but it does beg the question, should I be continuing to invest when equity markets are on all-time highs? And I think it's quite a natural human tendency to worry about what goes up must come down. We're naturally mean reversion creatures, so it's natural to worry when we see markets at all-time highs. But I would say it's important to focus in markets not just on prices, but on some of the fundamentals. And I think it's worth remembering that markets, like with so many other things, are upward trending. And actually, markets spend a lot of their time at fresh all-time highs. So in and of itself, hitting an all-time high is not a cause for concern. Markets tend to move up, inflation prices tend to move up, and that's the natural way of things. That's why every year we tend to see earnings growth in companies. We tend to see the prices of goods that we buy and services going up, hopefully not at the breakneck speed we've seen in the last couple of years, but markets are naturally upward trending. So markets that in and of themselves being all-time highs isn't a concern. What does tend to mean revert over time are valuations. And that's something we look at in the following slide. So in of itself, all-time highs aren't a concern. What we need to do is look at market fundamentals. And the two most important ones are earnings growth and then valuations. So on the next slide, I've taken some different regions. So, okay, let's think firstly about earnings growth. And if earnings growth is coming through, that can justify markets continue to move higher. And what we have here, another slightly noisy chart, but these different regions, we've got developed market regions at the top, EM, and then China, Japan in there, and the world at the bottom. The two bars here, the dark blue bars show the next 12 months, and then the light blue lines show expectations for full year next year. It's just two different ways of looking at earnings expectations for the future. And the two things I draw out and just sort of put a pin in as we then look later on, but the things to draw out here, you can see the US continues to exhibit strong earnings growth, 8% this year, then 14% next year is pretty strong overall. Emerging markets, 2 years of strong double-digit growth expected, pretty good as well. So US and emerging markets having strong earnings growth coming through. Conversely, you can see the only negative bar on this chart is the UK. The next 12 months is likely to have a little bit of pressure, much of that coming from particularly miners and some of the extractive industries. But then next year, growth, okay, 5% is pretty reasonable, but nothing to write home about. Equally, Europe, not too exciting either. Japan, fairly pedestrian. So the takeaway messages from this, the strongest earnings growth is expected in the US and emerging markets. UK and Europe a little bit more lackluster. But of course, earnings are only one side of the coin. The flip side is what valuation are you getting or paying on those earnings? So earnings growth is one fundamental. The next slide shows valuations. And here is where things get perhaps a little bit more interesting. We've looked at lots of different ways of slicing and dicing earnings here. In the previous webinar, we looked at equity risk premia. So that's how much more yield you get compared to a risk-free rate. This is another way of looking at earnings. And this is showing what is the price to earnings ratio is a pretty standard way of valuing equities. And all these bars show what's the current valuation on these different markets compared to its 30-year history, which is shown as the blue dot. And anytime the bar is above the dot, that shows that the market is expensive compared to history. And where the bar is below the dot, that shows it's cheap versus history. And you see across the board, actually, many markets are looking pretty cheap. The ones that most notably are expensive on the far right-hand side, US large cap equity is now looking pretty expensive. That's something we've talked about before. It's what we talked about last time. And as you'll recall before, yes, the US has strong earnings growth, but you're paying the price for that. It's not an unknown story. So the US looks expensive, but has earnings growth coming through. Whereas if you look sort of more towards the left-hand side, you can see Japan and Europe and the UK are cheap. And effectively taking those two sides together, we know that the US has strong earnings growth, but is priced accordingly, so looking a little bit expensive. UK and Europe and Japan have weaker earnings growth, but are at a discount, which is effectively why net there doesn't seem to be huge mispricing opportunities there. The one thing I would highlight where you see this biggest difference, if you look at European small cap, currently trading on around 13 times earnings compared to 20 times through history, that area is looking particularly cheap. And obviously, we'll talk in a moment on some of the elements that we did within that. So hopefully that gives you some sense. We're not worried about markets being at fresh all-time highs because valuations are pretty supportive outside of the US. And that's even clearer on the next slide, trying to make it less complicated than we had just now. Just looking at PE versus the 30-year average, you can see the US is around 20% expensive compared to history. UK, Europe and Japan, and indeed emerging markets are looking a little bit cheap. And that's how we tend to look at valuations in equity markets. I've only got a couple of slides on bonds, but it is important to touch on the bond market. So on the next slide, we can see the disappointing period we've had for bonds. Perhaps unsurprising given the backdrop. Year to date on the left-hand side, you can see even as equities have continued to rally, bonds have come under pressure. A lot of that is driven by the changing interest rate expectations. So hopes for cuts, aggressive cuts this year have been clearly dashed. Also, some of the inflation expectation is wrapped in that as well. Markets have rebounded from the lows that they had around about a month ago when global bonds were off around 4%. They have bounced back, but are still down 2% for the year so far. I will leave it to George in a few slides' time to talk in more detail about what's priced in terms of interest rates and some of the inflation background. But what I would point to on the right-hand side, this huge dispersion in returns. Normally, we don't expect in a rally that bonds will do as well as equities, but it is rare over 5 years. You have equities achieving 55% returns. So, you know, that is over 10% annualized return. That's very strong performance for equities. At the same time, bonds are down over that period. Obviously, that presents challenge for multi-asset investors. It means those that have had more of their portfolios in bonds, which are there for diversification over equities, have come under pressure, particularly if you've had that full duration. Of course, in our portfolios, we've had less exposure to bonds and that duration has been lower. So we've looked to try and mitigate against those effects. But this massive difference in performance is quite stark and it does create opportunities. And as always, there's the pain that some have felt as investors, but the flip side of that is some of the pricing opportunities that we see. And as those bonds have sold off, those have introduced opportunities for fresh investment. And on the next slide, which is the final slide for my section, just to put in context, as prices fall, yields rise. And yield is the return that you can expect for holding these bonds to maturity. And whilst it's been an uncomfortable period, this shows where we've been over the last sort of few years. Whilst you can see yields a few years ago were very unattractive, as they're priced now, the yields you can get on government bonds are pretty attractive. It's easy-ish to get 4.5% from bonds. Now, over the forward-looking period, the next 10 years, inflation's expected to average around 2 to 2.5%. So if you can get quite comfortably on a relatively safe, in inverted commas, if you're prepared to buy and hold to maturity, government bond, if those are yielding you 4 to 4.5%, whilst inflation is expected to be 2 to 2.5%, that's a comfortable 2% return above inflation. So 2% real return just for holding these bonds. That's actually quite attractive in a multi-asset portfolio. It also means other assets in the portfolio that tend to price off bonds look pretty attractive as well. So actually, returns are looking more compelling across the piece. And this is an area that we think could be sustainable and is an area that's becoming increasingly interesting, hence some of the changes we made to our portfolios. But that's really it in terms of markets. I will stop talking. Hopefully that gives you a sense of what's been happening and where markets are currently pricing things in. It's therefore a good opportunity for me to hand over to George to talk about the economics. Obviously, the economic activity is what's going to be key for where we go from here. So George, over to you for economics and trade wars.
Thank you very much, Ben. So let's recap a little bit what we saw in terms of both markets and economies, right? Because these two are interlinked. So risk overall now is slightly elevated. Okay, we're not talking about huge risks out there, but we do see them slightly elevated. Why? Well, on the one hand side, we have a lot of liquidity in the markets. We have the end of rate hikes and potentially rate cuts. We have resilient macro data, both consumption and employment, and more importantly, we have disinflation. Okay, inflation is falling. On the other hand, we still have quantitative tightening, which is not talked a lot about, but it's still there. So we do have the Fed sucking money out of the markets. We have services inflation, which remains sort of sticky, especially in the US. And we have geoeconomic fragmentation. In essence, what's happened is that we have now creation of big trade blocs that are increasingly fighting each other. And we're going to see this more in the last part of the presentation. Now, as part of this geoeconomic fragmentation, and of course, we have a very positive equity momentum, which means that valuations are not all that attractive, and all that is enough to tilt the needle slightly towards the elevated risk. Now, in the next slide, talking about geoeconomic fragmentation, which was exacerbated during the COVID crisis. Why? Because different countries employed very different measures. And as it happens with the economy, you make a decision today, and you see the results of that decision maybe 5 or 10 years down the line. Okay, and this is where we are. Now, China has decided, because of its property bust, to stimulate its economy a lot. So in the economic cycle, it is a little bit ahead of Western economies. It is in the part where central bank is more or less loosening officially or unofficially, because there are also a lot of soft and quiet loans in this market. So there is credit to go around. The UK and the EU are just behind that. They're in the starting position for rate cuts, but not there yet. Why? Because they're seeing the inflation, they're seeing persistent services inflation, and more importantly, they're seeing that the Fed is holding back. So one thing is that you're looking at your big brother, the Fed, and you're asking yourself, why are they holding back? And second, and more importantly, if you start lowering rates far faster, way ahead of the Fed, two things are going to happen. Your currency is going to weaken, which is not necessarily bad for trade, but it is bad if you end up importing inflation, because all American goods and services are going to be more expensive. And second, you could see capital flights. This is in fact what's happened to China. If you have an interest rate of, say, 3%, 2%, and the Fed maintains its interest rate at 5%, then people are just going to take their deposits from Europe and put them in the US for a better rate. This is keeping European central banks more on hold. Now, and a little bit back in the cycle. Now, the US is a little bit further back in the cycle. Why? Well, it's experiencing decent growth, and that means that inflation has become stickier. Why is it doing that? Because, well, they borrowed a lot of money, especially ahead of the election. Biden's primary concern right now is winning this election against Donald Trump, and he's pulled out all the fiscal stops to do that. Some inflation would come along with this, and U.S. inflation has been consistently above 3% in the last year. Although the U.S. was the first to experience disinflation, it is stuck there, and EU and UK inflation are now much more closer to the 2% target. Now, let's talk a little bit about our forecasts. This is not necessarily something, next slide, please. This is not necessarily something any analyst should do, revisit their forecast 5 months after they were made, but it is both an obligation and also it is good to see where we're at. So in the beginning of the year, we predicted that the dollar will remain the world's reserve currency. That has not changed. That economies will slow down in the first half, consumption will slow down, deficits will persist, and geopolitical tensions will linger. All of these things have happened and continue to happen. Now, and these were the more likely scenarios. Now, some of the less likely scenarios are not exactly playing out. The most important of which is that we predicted that there will be no sustainable bull market until quantitative tightening stops. So did we get this wrong? I'm not sure whether our bull market is necessarily sustainable, but what I do know is since the beginning of the year, US equities are up 10%. And since the beginning of quantitative tightening, they are up more than 30%. So the point is that we do see very strong equity performance. Is it a lot on Nvidia and tech stocks? Yes, there's a large part of that. But we cannot say for certainty that quantitative tightening has stopped a sustainable bull market. We predicted that inflation would stabilize, and we're getting there, maybe at higher levels than the ones we would wish, but that was sort of more or less our prediction anyway. And that quantitative tightening will end when rate cuts begin. Now, it is entirely possible that this is happening. The US has already started to taper down quantitative tightening, but it's still one of those predictions that are up in the air. We predicted that economies will begin to recover in the second half. It might be in the back end of that second half, but I think we're well on track for this particular prediction. And now for our less likely predictions, something important for central banks will break. The reason I have not changed the color on this is that it's the nature of that particular risk. We're still in May, and higher interest rates are probably pushing some areas in the market that we know little about. So we're still sticking to our guns, and we're still thinking there are risks out there, unknown unknowns, that could affect our asset allocation. The yield curve will steepen. A lot of friends from private banks have been on this particular trade, and I know they're disappointed, but we do still believe curves will steepen, and possibly even this year. That rates will come down mid to late second half in the US, or bang on in this one. That Europe will follow the US, I think that's the one we definitely got wrong. That is because, as we said, inflation in the US has been so persistent, and that the Chinese economy will rebound. We have not seen evidence yet of quite a very strong rebound. If anything, we're seeing evidence of weakness. So it's these two predictions that I'm more careful about. More or less, for most of the things that we have said, which were actually simple ideas, we're still very much on track in 2024. Next slide, please. Now let's move a little bit faster. We're going to talk about the global economy. As we said, it is slowing down, and we do see evidence, especially out of the US, that despite all the fiscal stimulus, now there is some evidence that economic activity is slowing down. Next slide, please. As we have said, however, inflation is falling for the UK and the EU, but it remains sticky in the US. That's your thick blue line over there. Next slide, please. As a result of that, And I'm going to remind people that we started the year with a prediction of 7 rate cuts in the US. We are now at 1 to 0, and a good and 2 rate cuts would be a very good scenario. 1 to 2 rate cuts in the UK and 2 rate cuts in the EU. I think the third, a potential third, would also be a very good scenario. Okay, so that's bond markets have been reined in from their extraordinary expectations earlier in the year, which is good. Next slide, please. As we said, in the US, we are seeing evidence of the slowdown. GDP has been weaker than expected. That's your left-hand chart over there. Employment numbers are soft. Both unemployment is climbing and payrolls are falling. And retail sales, especially the last number, was disappointing. Increasing pressures, next slide, is the fact that the American consumer has opted to spend money they don't have, but they borrowed from the credit cards at the 30% interest rate. So that's slightly making matters worse, right? Because it puts a cap on future retail spending. On the other hand, what we have is China. Now, China, next slide, has experienced a significant economic slowdown. And that has turned China away from its goal to become a strong economy with strong internal consumers and back to its traditional role as the world's cheap manufacturer. But now we don't want them to be, especially in the West. So, and we're going to talk more about this when we talk about trade wars. So they keep insisting on trying to capture market share and even possibly dumping some goods, especially in Europe. You see cheap electric vehicles across the board being sold. So what China is doing right now, it's ramping up production, it's ramping up production capacity. Nearly half of the world's plants, new plants built this year, are in China. So where does this leave us? This leaves us to the next chapter of our discussion, which is trade wars. Next slide, please, Zach. So here I want to take a small step back. Trade wars. Why do we have a trade war? Well, quite recently, the US increased tariffs significantly on electric vehicles, something like 100%. So basically, it's attacking nascent parts of the Chinese market that are very important for China's future growth as it shifts away from its previous model and as it tries to rebalance itself following the wreckage of the property slowdown. But the fact that China wants to ramp up production and sell cheap goods to everyone does not mean that the West is happy with it, because the US now seeks to reindustrialize. They figured out that you cannot have a strong economy if you're just based on the services sector, and you cannot be too dependent on China, because China might turn the taps off, and then what? And they learned that lesson well during the pandemic, right? Why? Because whenever China closed itself off to the world, it caused inflation spikes across the globe. So now they know they need to smooth things out. Is this the first time that's happened in history? No. Back in 1985, just as a caveat, I was 6 back then, so that's stuff that I read. It was Japan. It wasn't China. Japan had industrialized to an enormous point. It had brought in the best experts from the US. It had focused singularly on becoming an export superpower, and it had achieved that. So in 1985, what happened was that the US and other European powers cornered Japan into the Plaza Hotel, where Japan was forced to sign the Plaza Accord. In this accord, the next slide, please. The US dollar was allowed to depreciate significantly versus all other currencies, and about 50% versus the Japanese yen. So this was significant. You cannot reindustrialize unless you allow your currency to be weaker. Okay, and Japan was strong-armed into doing this. Now you're saying, well, what's the problem? Japan's GDP just doubled in relative size versus the US. Well, that's not exactly how this works, because when you're an industrial nation, you need a weak currency to be able to export. So the Japanese were allowed to buy US companies with their expensive yen, and they did that a lot. And if you ever see any movies from the late 80s and the early 90s, you're going to see a lot of Japanese executives, including my favorite Die Hard, for example, a lot of Japanese executives owning US infrastructure. Next slide, please. So this is how this played out. The Plaza Accord was signed in 1985, and as the dollar depreciated, obviously in terms of GDP, the Japanese GDP appreciated, but Japan lost competitiveness, and over the next 5 to 10 years, its economy stagnated, whereas the U.S. economy started overperforming again. So on the left-hand side, you have what happened until 1995, roughly even 10 years after the Plaza Accord, because these things don't work immediately. And on the right-hand side, you have what happened after that. Now, why am I talking to you about ancient history and you know, and Die Hard movies and all that? Because we get a very distinct sense that the US might try to go for this again. They might try to take trade wars into the next step, which would be currency wars. Now, China is not Japan. It does not owe its military might to the US. It does not depend on the US in any way, shape, and form, which means they will not be cornered in a hotel. So what can you do? You can target specific markets that are crucial for Chinese rebound, to get them to the table to sign whatever it is that you want them to sign. So whether it's Mr. Biden's tariffs that are very specific and very targeted that are going to do this, or whether it's Mr. Trump's tariffs, which are much bigger but also much more broad, that are going to do this, we get the feeling that this is the specific intent of both parties across the aisle in terms of China. And this is the first time we're talking more about trade wars. I promise we're going to talk more about this in the near future, because this will affect every business in the planet. It's going to affect every portfolio in the planet. Imagine what happened in 1985 to people who owned a lot of US dollars, for example, and they saw a 50% dip in the value of all US assets. It's going to affect the relationships and between central banks themselves, the relationships with the state, central bank independence. A massive trade war could have significant effects for all our economic and financial models. So I think this is something to watch. I know we might be slightly ahead of the curve, but I think this is going to be one of the key defining themes. Things have been coming to a head. And with that, I think it's time I give the mic back to Dr. Ben, and we can close it off.
Thank you very much, George. I've just got a few quick slides on investment asset allocation to try and bring this back, because fundamentally one of the core services we offer is managing clients' portfolios, and many of you will be clients. So in the second quarter, it was just after the last meeting, the last webinar, we made a few changes that I'll talk about very briefly. In terms of asset allocation, we reduced our short-dated government bond positions and added to benchmark duration. What that effectively means, when we said earlier that sell-off has meant that bonds are looking more attractive, the short-dated end, you tend not to get as much benefit or sensitivity to interest rate movements and yields than at the longer end. And the benchmark, the sort of normal bond, is closer to 10 years. So that short duration area is where we've been holding to try and have a defense against that broad sell-off. And as we said, moving to the longer end makes an attractive move there. We've also done some style shifting. So funds that historically have had a bit of a value tilt, we've looked to balance those out by increasing some of the growth tilted exposure. That's a bit of a style call. And then finally, we made one fund change. So across the board, where Barings Europe Select was held, we've replaced it with a low-cost index tracker, an ETF. Part of the reason for that, the fund, whilst Barings Europe, we have no issues with the fund in and of itself, it does tend to have slightly larger, more medium-sized companies rather than a sort of pure exposure to European small cap. And as you saw from my slides a little while ago, European small cap is a part of the market that is looking particularly compelling. So our preference there is for an investment vehicle that could be much more focused on that area that we think there is the most value on. On the next slide, I've just taken one of our model portfolios just to try and help illustrate what that means in practice. Again, if you're a client in this service, then a rebalance note that sort of explains the changes, put them in context, is available. So please reach out to your financial planner if you haven't received that and would be interested. But you can just see here are the how we actually implement it in portfolios. You can see here we've moved around just over 6.5% moves at the latest rebalance. This is just on the capital growth model. Equivalent changes will have been made in the other models, and that translates to a sort of 13.5% sort of swing effect. And then on the final slide, the main presentation, I just want to talk a little bit about where we're positive, where we're negative. So this shows where we are positioned an asset allocation point of view versus our strategic weight, our neutral weight. The changes we've made over the last year has actually brought a lot of these active tactical tilts in. As we said, across the board, we're pretty neutral, broadly speaking. That's because parts of the market where growth is strong are priced accordingly and are looking a bit expensive. Areas where growth is weak are priced accordingly and are a bit cheap. So it means there's not a huge mispricing opportunity. One area where we are underweight is in alternative fixed income. So these are the slightly funkier parts of the bond market, emerging market bonds, high yield bonds, also called junk bonds. If you own them, you call them high yield. If you don't, you call them junk. These are slightly racier parts of the market, but we think as there's a little bit of fragility out there, we don't necessarily want to be overexposed to the cycle. What we do want to have, though, is the ability to participate in further growth. You get that best, in our view, in these sort of mainstream equity markets using broad exposures and high conviction managers that we invest via. The area we're overweight is in equity diversifiers. This is specifically in energy. We think if you look broadly out there, some of the risks abound. We think energy equities, so these are equities exposed to energy, it's got sensitivity to oil price. When you do have these geopolitical risks and the potential for shock and the potential for inflation, if it does, not a base case, but talking earlier to George's unknown unknowns, we want to have parts of the portfolio that if we do see a repeat of that, given how fragile and volatile the outlook is, we have some bits in the portfolio that can effectively hedge against unknown unknowns as well as known unknowns. And we think energy equities are very good for that, and they're priced pretty cheaply. It wasn't on the earlier chart. Natural resources was on there looking a bit expensive. If you specifically look at energy, they're trading on around 10.5 times multiple compared to the long-term average of 17.5. So it's a cheap area to have exposure to, and it can provide hopefully some buffering against those geopolitical shocks. But I really just wanted to add in a bit of investment and asset allocation context to these webinars. Do let us know if you think that is helpful or if you'd rather us, not have that necessarily going forward. So that's it in terms of the main presentation. If we now on the next slide move to the Q&A, I've got a few questions that have already been submitted. Some are for me, some are for George. Any other questions, do please put them in the Q&A box, which should be at the bottom of your screen, and we will get back to them. Whilst you come up with those and whilst I ask them, I will just move on to the next slide and leave this perhaps to frame. This will add in, sorry, it's text heavy, but this is our topical cheat sheet. Many of you will say, oh, but you haven't talked about the election or you haven't talked about AI. I just usually have this side up to highlight we talk about and think about all these things almost constantly. 9 times out of 10, they won't have an immediate investment impact or they feed into our broader thoughts. So here's just sort of one-liners on the topical areas. If you do have more detailed questions, again, pop them in the Q&A, but hopefully that helps with some of the framing. So if I turn to the questions, there's a couple for me and a couple for George. I'll pick up the first one, and this is from Marco, who asks, what's our view on the best time in the cycle? Is it best to when is it best to move from defensive investments, client cites the example of credit, into more upside geared ones like equities? Two things I'll say here. Firstly, calling the market is incredibly difficult. So we have a lot of indicators to try and see where we are in the cycle. George has his economic cycle earlier. There's the market cycle as well. The thing we have to be most careful of is false dawns. But what I would say, in the question, defensives, people often think about low risk investments like bonds and other asset classes versus equity. You have it within equity as well, though. There's more defensive parts of equity markets. Think the likes of utilities and healthcare. There are more sort of cyclical areas like small caps and value. So in terms of the market cycle, defensives tend to do best when you're in sort of the late stage in the contraction phase, when economic activity is slowing then falling. That's when defensive areas tend to do better. Where the more upside geared ones tend to do better is generally in the recovery and expansion phase. That's when equities broadly will do better, but particularly small caps, those are more geared into that rotation, tend to benefit. The problem is it's never entirely clear when that will be. At the moment, we think we're sort of, potentially late stage, maybe starting to move through into expansion. Obviously, UK and Europe have come out of a recession, so that could be the start of recovery. But as George highlighted, over the other side of the pond, the US is showing signs of some economic slowdown, and the US economy can dictate what happens in the rest of the world. So when we do move from contraction into recovery, that's probably when one would broadly consider moving into more cyclical exposures. Getting that call right can be very difficult, particularly when central banks have interest rates very high. Normally, rates are hiked late in the cycle to bring economic activity under control before rates are then cut to stimulate that activity. So we're currently, we know roughly which half of the clock we're in. Knowing specifically when is much harder. And again, that's why we're pretty neutral across the board. So hopefully that answers that question. George, there's two for you, so I'll go with this one first from Cuban. Beyond traditional metrics like GDP growth and inflation, what unconventional indicators are you watching closely to gauge the true health of the global economy, particularly in the face of ongoing disruption? George.
So we're looking at trade indicators. First of all, we're looking at roughly 250 indicators per month. And we're looking at them across different regions. And no, GDP is not actually one for us to look at. We do look at inflation a lot lately, but not GDP. GDP is a backward-looking measure. By the time we get the real number, i.e. the fully revised number, it's 3 months past. So no one in the market is really looking at GDP as anything other than, a very broad and backward-looking measure. But we're looking at retail sales. We're looking at, as we said, inflation, employment. The most important indicator, if you want to look at something, would be PMIs, purchase manager indices. They ask purchase managers what are their conditions for their factories and their businesses. And Market, that does the polling, actually lets people have that for free through their press releases. So if you really want to look at another indicator, that would probably, it's a lot of reading, roughly 20 pages per month, but definitely recommended.
Great. Thank you very much, George. Another sort of market one that I'll pick up from Andrew. The question is, do we expect another stock market rally in the fourth quarter on the assumption that we've said that the rates are cut in the third quarter? I would say possibly, but not necessarily. I think when we think about investing, trying to forecast the future is almost impossible. What we spend more time on is thinking, are we being rewarded for taking appropriate risk? And I think at the moment, the market is anticipating cuts in the third quarter. So to an extent, that's already priced in, at least partially, to where markets are are now. So if that was to be moved out, then you could see disappointment. If they move forward, if they were larger in magnitude, that's more likely to be a cause for a rally, because markets discount what is expected, and because we've already got that in, arguably, the run we've seen recently, that is the relief we talked about, is the pause, which is then expected to be followed by a cut. I think the two things that are most important: firstly, what happens between now and the third or fourth quarter. If we do have some disappointment, that could set the stage for, if we do have cuts as expected. George has talked about one or two cuts priced in. That's fluctuated a lot, as George talked about. So a lot depends on what happens between now and then, and where expectations are versus reality. I think whether or not we see a rally in the fourth quarter, to me, it almost depends on the flavour of those cuts, because interest rate cuts are still quite likely, and I'll ask George to follow up to that in a second, because that's the other one for him. But it depends whether they're what we call bullish cuts or bearish cuts. So if they're bullish, effectively that means inflation is coming under control, economic growth is strong. We can therefore reduce interest. You keep real interest rates steady because inflation is coming down. You reduce interest rates in line with falling inflation. That's a good scenario. That will set the framework then for a fourth quarter potential rally if central banks can cut rates in following inflation, and that's a good news story. Conversely, if they have to cut rates because they have crashed the economy and are trying to kickstart it, that's going to be pretty negative, I would say. And that's what we're looking for. Whether or not this slowdown in the US accelerates, because all of these things operate with a lag. So if the cuts are because they've crashed the economy, need to stimulate it, that's probably not a great environment in the second half for a rally. If they can continue to cut amid ongoing economic strength, but because inflation is falling as supply issues resolve, then that could be more positive. But as I said, the reason we're neutral is because a lot of that is priced in. So we need to see, there's still quite a lot of time between now and the fourth quarter. We'll have to see how things, how events unfold. And so following on from that, George, another question we've had in is around US rates. And obviously we've talked about the cuts, but there has been some talk. So what sort of probability do you ascribe to actually the next move in the US being, or no move this year? Or what if the next move is a hike? How likely is that? Because there has been some talk of that, hasn't there?
Yes, there has been some talk. I'm firmly in the 0 to 2 camp. I think the probabilities for any of these three events are strong collectively. I think a hike is something the Fed is telling markets to cool expectations, to manage expectations, because managing expectations is something very important. It's a very important function of the central bank. Okay, but having said that, I don't think the data is there, because we do see a slowdown in the US economy. We do see a slowdown in inflation. So the data is not there for a hike, I think, Ben. I wouldn't ascribe it a significant probability.
Thank you very much, George. The final question we have in, so if you do have any more questions, please pop them in the Q&A. Otherwise, we'll wrap up after this one. This is more about the service, and this is from David, saying that there's a great deal of talk about fees in the financial press and what our position is going forward. I think there's two different levels to this. I think in terms of the overall service that clients get, obviously there's lots of layers within that. There is our sort of financial planning and investment fee that we charge. There are platform fees. And then there are underlying investment fees. From our perspective, I think it's absolutely crucial to make sure that fees are appropriate and that clients are getting value out of those fees. So a lot of what we focus on broadly is the performance of value added after all of those fees. I think that the fees that we have at Mazars sort of for our layer are absolutely appropriate and competitive, and it's an area that we obviously monitor to make sure that we think clients are getting value. And then when we look at the underlying investments, in particular active fund managers, there's a great deal of pressure coming from index trackers and index funds. So on the one hand, you have active managers that pick stocks that they think can outperform or deliver over the cycle. And then you have index trackers or exchange traded funds that are very cheap and just give you broad market exposure. And that's something in the investment team that we look at a lot. And in the portfolios, we have a blend, as you saw a few slides ago. In some areas, we will go for index exposure. If we just want broad exposure to an asset class that we think has sort of structural or tactical advantages, then we will just go for a very low cost index exposure to keep the costs under control. There are areas where we think active managers can add value. That's both where we find good managers or we find parts of the market that are more amenable to active stock selection. And there we will look for managers that we think can add value after fees. So the performance you see of those underlying funds is after fees. So we make sure that firstly, they can deliver after accounting for their fees, but also we work quite closely with our partners in the asset management world. So when we look to invest in a fund, we will negotiate as hard as we can to make sure that we get the lowest cost exposure to them. And on our clients' behalf, we're actively involved in discussions with asset managers to make sure that their fees are as low as can be feasible to deliver that net of fees performance. And in particular, that challenge between index products and active management, we really make sure that where we do go with active management, that we are getting really good value within that. And that's why we have a blend in the portfolios to keep the overall all costs what we think is good value for our end clients. So those are all the questions submitted in advance. I don't see any more coming through, so I will just give it a few more seconds for anyone that may be quickly typing. But if not, if we can just, while people are doing that, I'll just point to the last two slides in the presentation. On the next slide, we have got our contact details. So you've been listening to myself, Ben Seeger-Scott, and George Ligarius. You can see there as well the links if you do want to follow us on LinkedIn, Twitter, or X, Facebook, and Instagram. All of the details are there, and obviously a great deal of content is provided. And then there is a final slide just in terms of important information. I won't read it through, but there is a lot of important information here just to contextualize the business and this presentation. So please do take that on board as well. And I will leave that up. There are no more questions in the Q&A box. If you do have any more questions, you think of anything afterwards, please do reach out to your regular Mazars contact, and we'll be happy to try and answer as best we can. Otherwise, thank you all for listening and watching, and we look forward to seeing you again soon and hopefully see you on the next webinar. Thanks very much.